There's another one. Okay, I'll wait another few minutes because it seems like a couple other people are joining now.
Should I stop messaging people? I'm sorry.
Whatever, it's okay.
Hey, Victoria.
Hey,
Victoria,
hello.
how are you guys?
If they
Hey,
get, I mean,
James, hey, Tina, hey, Amy.
It's like,
Amy.
Non-participatory, but I'm here.
okay. We're just waiting for more people to join. You know, I think pretty much everybody who reserved is joined. So
I
I'll
think you
try
should
to
go
see
for
every
it.
couple minutes if somebody else is joining, but I was explaining and there's a lot to cover. So I really want to start and cover this, you know, get this covered. Okay. So can everybody see my screen share?
Yep.
Yes.
All right. So as I was explaining before, this is kind of a dual purpose. There's a lot of tax deductions out there, but this is a dual purpose presentation. One is to show you if you already have a business in place, basically deductions that you could be taking that you're not thinking of. And there's a lot of them, trust me. You know, the second thing is if you're a W-2 employee, how it's beneficial for you to have a business, even if you're a W-2 employee, that there are everyday living expenses that you can direct into tax deductions for yourself and save a lot of money. So with that, I'm going to go ahead and start. So when I was asking, does everybody understand what taxes are? I basically wanted to go over very quickly when you have a W-2, when you're a W-2 employee, what taxes are being deducted from your paycheck. So FICA, which is Federal Insurance Contributions Act, is actually a combination of two different insurances. And I apologize if there are people here who already know this, but I wasn't sure who did and who didn't know it. So I just wanted to cover it briefly so you understand what's being taken out of your paycheck today. And it does kind of impact what you, as a business owner, some things that you can reduce in your, you know, if you're a business owner.
Victoria.
So FICA is made up of Social Security, which is also called Old Age Survivors and Disability Tax. The Social Security collects those to take care of people who are, you know, starting at 65, or as we get older, 66, 67, 68, or younger people will be later. Survivors of spouses of people who die, and disability, anybody who's on disability can also do. It's 6.2% of the paycheck is deducted from your paycheck. The employer has to match that. So if you're self-employed, you're paying 12.4%. This is actually limited to $142,800 of your paycheck. So there is actually a limit to where after you reach the $142,800, they stop deducting this from your paycheck. Okay.
Victoria.
Yeah.
Just a quick question. Are you going to be sharing this stuff, like this presentation, or no?
It's recorded and I'm going to post it in the group. It's being recorded. Victoria, since you took a little break, is there anyone in the waiting room real quick?
I just added 2 more people.
Okay. All right, cool.
Yep.
All right, awesome.
Yeah. So yes, I'm going to record it and I can share this presentation. I don't have a problem with that. All of this information is readily available on the internet too. So every year, this 2021 income limit, it goes up a little bit every year. So they are actually, I guess, increasing it for inflation. I think it's a couple $1,000 it goes up. Medicare is what your hospital is also called hospital insurance. That's the 1.45% of your gross pay, and your employer must match that as well. There's no income limit. If you make $1 million, you still pay 1.45%. But I can show you some ways that you can actually, if you're self-employed with an S corporation, that you can actually avoid paying these self-insurance, these FICA charges. So that's one part of your paycheck. If you're self-employed, you have to match it. Then on top of that, so, you know, if you start figuring out how much of your paycheck that is, just multiply what your paycheck is, what your monthly, your annual pay is times 7.65%. That's the first part that goes to the government. The second part that goes to the government is your withholding. You usually fill out a W-4 at the beginning of the year. At the end of the year, you get your W-2, which includes your federal withholding and your FICA. You'll see that on there. The way that it works is that if you're single for 2021, you take the first $12,550 off of your gross pay, whatever that net is. Now we have what we call a progressive tax system. So if somebody says I'm in a 22% tax bracket, well, it's not quite right. It's actually a combination. So up to the first $9,950, if you're unmarried, it's 10%. Then the next, you just go up incrementally for your taxes. The same thing, with any of these various. So, you could be paying, somebody who's making, let's say, $50,000, $60,000, you could, and I'll have an illustration in here, could be paying quite a bit of money in income taxes as well if you're a straight W-2 employee. Okay. I don't see anybody else waiting, so I'm going to move on to the next slide. Oops, one too many. So I also wanted to kind of go over the different kinds of taxes. You don't realize maybe that you're paying all these. Maybe you do. I don't know. But again, I just wanted to point out that you're also, if you, have sell an investment or an asset like a home, to a certain extent, again, there's some things that are not taxed as capital gains. Those brackets are less. They're 15 and 20%, but there's also a capital gains tax. I'm not going to go into the detail of all of these because there's just a lot of that, and we've got a lot more. Then if you're in a, go ahead.
So just to clarify, so if you're a W-2, you're paying all the taxes on the right?
No. Only the first slide. These are additional taxes that you may or may not, as a personally or as a business, you may pay.
Oh, okay. And so the slide before was
It's only that's your W-2 stuff.
which, okay, so where is that? So just the FICA, the Social Security, and the Medicare.
Your FICA is combined of Social Security and Medicare.
Oh,
It's
okay.
actually 7.65%. And then you've got your regular withholding tax, federal income tax. That's what a W-2 employee would pay.
So W-2 employee pays the FICA tax.
Right, just the 7.65% and then on the right side, you're going to pay withholding.
So you're paying on top of the FICA, you're also
Correct.
paying withholding.
I'll show you as we move along. The fourth slide has a specific example showing you all these.
What's the withholding for?
Your income.
Oh, so that's just kind of like what they use to run the country, and the rest is for Social Security and Medicare. Okay, I got it.
Correct. Yes, sorry. Yes, exactly.
All right.
Okay, so here are other taxes that you may or may not have to pay, whether you are a business or personally. And I'm getting to the point where I'm going to show you the ramifications of what you're paying and what you could be writing off as a business. So you could be in a state that has state income tax. Okay, in Florida, we don't have state income tax. There are, I think, 5 or 6 states that don't have income tax. All the rest have state, city, county. I'm sure that some of you I know are from up north in some of the northern states that do that, or actually other states. If you're a corporation and you're a C Corp, you pay corporate income tax. Then, of course, we all know we have sales tax. The employer pays something called unemployment tax. Some states for businesses charge franchise tax. Excise taxes are when you pay extra tax on fuel, on alcohol, on health insurance programs, and on tobacco. If you own a piece of property, you pay property tax. You pay estate tax if there's somebody that passes away in your family. I know all of our cell phones say, oh, the tax is included with our cell phone tax, with our cell phones. Well, there's a tax in there. It's just that they've embedded it or imputed it into the fee you pay every month. Some states have soda tax, or not even states, actually, I should say counties and cities. There's no state that's mandated this soda tax. Sorry, marijuana tax. Oh, I have a state tax twice. And then there's a gift tax. There's a gift generation skipping tax. My point is that you get taxed a lot. So there's lots and lots of taxes that we pay. Come on, next slide. Okay. So here's where we go into business ownership and some of the myths that are out there about owning a business. If you worked full-time, you don't get the same benefits for tax deductions. Not true. Big businesses have different deductions. No, they don't. They're exactly the same. There's 10,000 pages of tax code, by the way. And I should have prefaced all of this with saying that, giving you a little bit of background for me, I've been a corporate controller for 35 years. I went to school, I got a master's degree. I sat for my CPA, passed, had it for 4 years and decided that I didn't want to be a form filler. So I elected to become a corporate controller and work in businesses and help businesses run more efficiently and effectively. So big businesses have exactly the same deductions. There's no difference. However, the tax code does change a lot every year. So I choose not, I have people I rely on to let me know what's new and updated. You have to make a profit in order to take advantage of tax deductions. Nope. And your accountant takes care of your taxes. That's probably not true either. And we'll go into more detail on that. And I'll tell you why. So taxes are our greatest expense. You probably may not realize this, or maybe you do. We pay more in food. We pay more in taxes than we pay in food, housing, transportation, and clothing combined. And because of this, lowering your taxes can be the greatest and quickest way for you to build your wealth. You have to focus on lowering your taxes as much as legally possible if you want to get ahead. The average family overpaid $4,000 to $8,000 last year by not having a home-based business.
That's a lot.
It is. So here's a little illustration, as I was saying, of basic, and again, I took basic monthly costs. And what I want to show you is why, unfortunately, with our two tax systems in this country, people are going into debt. So I took a single person. This rent is probably really low, but I just wanted to give some ballpark figures of what it costs per year to live. These are monthly expenses: rent $1,250, utilities $150, internet, phone, cable. You can see that these are not huge expenses. I actually was very minimalistic. But if you think about it, these are the kinds of everyday expenses that people pay. Okay. That all totals about to $41.75 a month. That annualized by 12 months is about $50,000 a year. So the average cost for a single person living alone is about $50,000. It varies. Some costs are higher, some are lower. Costs can be reduced by living in a shared unit. The biggest unknown cost, excuse me?
Or in a box.
Right. The biggest unknown cost per person is student loan debt. That I didn't even really figure. I figured a small amount there, but it's probably higher. And this example is based on a non-income tax state like Florida. So the next slide will be my showing you how much you pay in taxes and why our country is going into debt as a W-2 employee with no home-based business. If you get paid $60,000 a year, which is about almost $29 an hour, and you take your single deduction, you're left with $47,000 to be taxed on. Okay, you take your 7.65% of FICA, and in the state of Florida, and there's no state tax in Florida, but you do your calculation, which is down here, the first 10%, $987, The next 12% is $3,600. It basically, your federal income tax is $6,200, which gives you a yearly tax bill of a person who's making $60,000 a year of $10,850, which leaves take-home pay of $4,900 for that person. If it costs you $50,000 to live, you're going into debt every single year, $851. Do people realize that's going on?
Oh, I make such little money that my accountant told me, he said, you know what, Amy, the government will accuse you, you can't live in New York based on what you're making and the taxes you pay on it. He also said you should stay home and just collect welfare because what are you doing? It's all going to taxes. Oh, I'm so aware. And I think you guys in Florida have it all right. I think I'm moving there next week.
Come on down.
So this is where I'm telling you it's a two-tier system here. So the tax code is structured so W-2 employees continue to go into debt year after year. Business owners have more favorable advantage, but of course, a business owner takes a lot more risk and is supporting the W-2 employee infrastructure. This example is a non-income state. Taxable liability is worse with people who have income tax to pay. So it's important for you to understand how your deduction is being done and how your income is being calculated. Later, I will give you the link to irs.gov to find your withholding calculator so you know how much you're doing. So most people think it's great to get a refund in April because they're over withholding on their federal income tax. Guess what? You're giving the IRS an interest-free loan and while you're going deeper and deeper into debt. And a lot of people don't realize.
Thank you for saying that. I worked with so many people who acted like it was free money.
Yeah.
And I would say to them, no, you're loaning the government money. And they just didn't know what I was talking about.
Yeah. So here's a little example again of redirected normal monthly expenses redirected into real business expenses. You'll probably need some more additional training and we'll go into that more with a professional to show you, but it's extremely, important. And we'll go into more about how a trade, how business or trade is defined. But again, I want to go with, these are example of home-based business deductions that you can redirect. So in this case, I was doing it for a network marketing company. And so in that case, if a person has a monthly product order in this case, or some sort of sample order, they can deduct their personal use order as samples in their home-based business. Your internet, your phone, mileage, home office, the square footage, and we'll go into more details on how these are calculated, and business meals, continuing education, travel, events, software subscriptions, social media advertising, office supplies, an accountant, your returns, interest, parking, charitable contributions. Some of these are might be a portion of it too. This was just a quick example of about $1,500 that maybe you're spending right now that you could take and deduct them into a tax deduction. Okay. Children under the age of 18, you can hire your children. So there are a lot of different techniques and methods where you can do that and you can reduce. So I'm going to show you the example on the next page. To be deductible, a business expense must be ordinary and necessary. It's common and accepted in your industry. It's helpful and appropriate to your trade or business. And it does not have to be indispensable to be considered necessary. I'll go into a little bit more about, in order to be defined, you have to engage in an activity carried on to make a profit. It is not the IRS's prerogative to say what.
Victoria, I'm sorry to interrupt, but there's some kind of background noise. I don't know what that is. Does anybody else hear it?
Yes,
Yeah.
I think it's Judy.
Oh, there's someone waiting to get in the waiting room, by the way.
Yeah, but I think that was Judy trying to fix her thing if she can mute.
I can't see usually something pops up, but I don't see anybody popping up right now. Let's see.
I'm trying to get into on my computer.
Oh, so wait, did she get in already? It was Christina.
No,
Oh,
I'm
let's see.
on my phone. I'm trying to get on my computer.
Oh, okay.
Yeah, if anybody sees anybody in the waiting room, I just can't see. I don't see anybody. Usually it pops up and I can let them in as I'm going through the presentation. But I don't
You can
see
mute
anybody.
yourself so we don't hear the sound. It was hard to hear over the
Yep.
sound.
Whose meeting is this? Is this Victoria's meeting or is this
Yes.
Bill's
Yes.
meeting? Yes, I mean, you're waiting for the host to start the meeting.
Yeah, it's she's in my login.
Oh,
Yeah.
Okay, so let me go back. Okay.
Yeah,
I'll
just
mute.
log
I'll
in
mute.
together.
Yeah, I'll
So,
mute.
it's up to, it's you have to prove that you are in a trade or business. It's not the IRS coming and saying, oh, you're not in the business, okay? And we'll go into more details, but all you have to do is have a furthering interest in continuing to do your business. So here's the example I was explaining to you. Remember that $60,000 a year employee? Well, now they have a loss. Just say it's a loss. Maybe they didn't make any money, or maybe they made some, but they have this $18,000 loss. Well, the difference becomes here that flows through to their tax return. Now they're only taxed on $29,600. Your FICA is still the same on your W-2 wages, but now your federal income tax is markedly reduced, and you now have almost $2,900 more in your pocket. Okay, so the IRS code is built in the favor of the entrepreneur and the business owner. You know, there's a lot of questions, obviously, that need to be answered, and we'll go into some of those in more detail. But I'm going to explain a little bit about the two tax system. The tax system, number one, someone has to pay the taxes. Business owners create economy, they create businesses, and W-2 employees pay the majority of the taxes. So you should be doing everything in your power, if you're a business owner, to keep more tax dollars. All right. The second one is to create wealth. Business owners get more opportunity for tax deductions, and those deductions allow you to keep more of your money so you can reinvest it, grow your business, and have more W-2 employees. Small businesses create over 70% of the growth in North America, not Apple or Amazon. As you may know, Apple and Amazon haven't paid taxes in a long time. And we're going to cut in. So when somebody says, hey, you know, what if I have a loss year after year after year? We're going to go through some of those myths. But here's the deal on what you have to do in order to have a company and to, you know, have these business expenses be written off. There are individual circumstances, but your objective has to be profit. You have to make an honest attempt and have a deemed business motive. What that means is, you know, the least amount of what I've seen is available is if you are working a business, let's say 3 days a week for 45 minutes to an hour a day, that's a business. You are doing something to make that business move forward. There is no such thing. There's a myth that you have to have a profit 3 out of 5 years to make a profit. You don't have to have that. You just need to prove to the IRS that you're truly attempting to earn an income. So that's one of the myths that are out there. So how do you do that? The importance of that, how do you do that? There are different business entities, and I will hand out I have 3 handouts that I'm going to give you. One of them is a business entity selection. But the most favorable business entity selection, when you get to the point of making somewhere about like $25,000 a year, or this one says 12, but I think it should be a little bit higher. It's up to you, is to create an LLC. An LLC limits your liability. And then there's another form you fill out to have it act like an S corporation. Here's what's important about the S corporation. You can take a salary of $20,000, $30,000, $40,000 and you pay that 15.3% of self-employment tax. But let's say that your company makes $100,000 and you take $40,000 as a distribution. That distribution does not get taxed, the self-employment tax. So what generally is recommended is a business owner, and it's funny, I just talked to a consultant a little while ago. She says, I have people that are making $1 million in their business and they're taking a $40,000 salary because they don't want to, and they're taking their distributions, but they aren't paying that. Why pay the Social Security? And she gave me some figures, like only the first $6,900 of what gets deducted actually goes to you. And then anything over that starts going to other people's Social Security. So essentially you're supporting other people's Social Security when you're having, a larger amount of self-employment taxes for Social Security, for FICA, I should say, deducted from your paycheck. And I'm going to get those statistics shortly. But the LLC with an S corp allows you to treat it as an S corp for tax purposes, and it allows you to bypass self-employment taxes. Also, there's a new tax law that came out in 2018 where anything that comes through on an S corporation, a partnership, or sole proprietorship, 20% of it is not taxed. Only 80% is. So the full pass-through of net income is not taxed on a business. So that's another benefit. Thank you, Mr. Trump. Sorry, I shouldn't have been political, but we don't know what's going to happen next, whether or not that's going to be taken away. But that's the Tax Jobs Creation Act that was created in 2017. So what's tax deductible?
Oh, sorry, can I just quickly ask about the deduction that you mentioned. The deduction that you mentioned, is that like a dividend? Is that why?
Which deduction?
So when the company makes some income, like makes a profit, you said people take lower salaries and then they take the distribution. So that distribution, where's that tax? Like, is it taxed nowhere? And like, I don't understand. So
there's different types of tax structures, just real quickly. There's a C corporation. If it's a C corporation, then there's shareholders and the profit, or they're actually double taxed. They're taxed by the corporation because corporations take, have their own taxation as a C corp. And then if a shareholder gets a dividend, they're taxed. So you want to stay away. Most people stay away from C corporations because it's a double taxation system. An S corporation, they do something called a pass-through, okay, an LLC. And so what happens is a Form 1120S is created. At the end, it is purely an informational tax return. On that return, there's something called a K1 that's distributed to the owner, and the amount on that K1 then gets included as income on your 1040S. Okay, and then you're taxed at whatever your income bracket is. Now, when you do that, you avoid the 15.3% of Social Security. When you have a corporation, you have like an S corp, you have the right to take what they call an owner or partnership distribution. So if you make a profit, you can distribute those profits to yourself in a distribution.
So you're paying yourself.
Correct. You're paying yourself with a W-2 for a small amount just to show what they call reasonable salary. So the IRS also knows that business owners are going to try to circumvent the Social Security tax. So there's a clause out there called reasonable salary. You have to pay yourself a reasonable salary, which again, people that I've worked with in the industry, other accountants that I correspond with, it's usually 25 to 30% of your net income is what's considered a reasonable salary. Then after that, whatever's distributed to you, you're not paying those Social Security tax, the FICA taxes on.
But do you pay any tax on that? on the
Yes,
distributed
you're gonna
money?
pay your regular net, yes, it flows through to your regular tax return, so you're paying your, whatever's in your withholding, you're gonna pay. Whatever your tax bracket is, so if you back up
Yeah.
to, yeah. Yeah,
Could it-
you understand?
Which is
Hey.
normally a lot less than the corporate tax of 35%.
That's correct, which actually that's been lowered. However, if it's a C, if it's, so you're only gonna get corporate tax if it's a C corp.
Yes.
And those tax brackets actually got lowered, but we don't know what's gonna happen in the future. They may go back up. But also if you have a C corp, you're going through double taxation. The C corp's paying, and then the shareholder, when they get a dividend, it becomes dividend income and you get taxed again. So you definitely don't want to be in a C corp, certainly not as a business, small business owner. I'm not quite sure what the advantage is, to be honest with you. Okay.
So, Victoria, one more question. So I'm an S corp
Yes,
and I pay myself also very little,
yes.
like literally almost like what you said. But now I ask like my CPA, okay, what's my corporate tax? And he's like, as a corporate, you don't pay tax.
That's correct.
You pay personal tax, whatever I guess I pay myself. And if I don't do distribution, money stays in a corporation. So it looks like it's growing, right?
Yeah.
If I don't pay myself, so it stays in the corporation and I can use it for my further expansion.
You can. It's your
Correct.
choice as an owner what you want to do. You can distribute it to yourself, or you can keep it in your business. That's the beauty of being a business owner. You have that choice, and that you can hire more people, you can expand. However, just so that you understand, what happens is that you have an income statement. At the end of that income statement is net income. That net income, if you made $50,000 in net income, that's going to flow to your personal tax return, and you're going to be taxed at that, you know, whatever your tax bracket is. So understand that they're two different things.
Yeah, it's not like indefinitely, right? Gonna grow. It's gonna flow one into other.
Correct. You're probably doing an 1120S. You get a K1, whatever is showing up as net income on that K1 is flowing through to a line item on your 1040. And you're going to be taxed your regular tax bracket on that. There's some other things that, you know, that can be done, but I'm not, yeah, it's like, I'm not going to teach tax today. So
Yeah.
anyway, but you know, more questions you can ask me and I can help out with showing you how that all works. But so what's tax deductible? Any expense incurred for the purpose of producing income. Okay. Incurred within a reasonable expectation of resulting in future business and is reasonable under the circumstances. Okay. So who's helping you with your business and your taxes? Let me explain a little bit about what each one of these people do and why sometimes what you think is happening really isn't happening. So a CPA actually stands for Certified Professional Accountant, right? Certified. The certification really means that that person can do SEC work, they can do audits, they can do reviews on tax on businesses. It doesn't necessarily mean that they can file tax returns, although many of them do. You don't have to be a CPA to file a tax return. There's actually also something called an enrolled agent, which is actually federal. Anyone can be a tax preparer. You don't have to have a certification. CPAs, in my opinion, and I'm just saying in my opinion, and this happens a lot, we call them copy, paste, add people. And if anybody's a CPA, I hope I'm not offending anybody, but I did sit for the CPA. I passed my test, I got certified, and I found that it was only good for me to do securities work or audits or things of that nature. Basically, a CPA or an accountant who does tax returns really is getting, at the end of the year, historical information from you. They are not doing tax planning for you. They're doing tax preparation for you. It is only as good as what you give them. If they do 200 or 300 returns in a tax season, they're spending about 2 hours on each return. Most of their work is done in 6 weeks, and they aren't there to help you necessarily save on taxes. They are a preparer. An accountant, again, is doing historical information. Whatever information you're giving them, they're recording. Bookkeeper, the same way. You have a payroll company who's doing your payroll for you. And then you may have a business coach, but if they're not communicating with what's going on in the company, they're not seeing the historical, they're not looking at how you can save money. You know, you've got all these different people perhaps helping you with your company, but they're not talking to each other. So you're not getting any planning or preparation or advantages of doing anything. Very little, because now they're looking at the past. Oh, I think a couple more people want to come in, and I can't seem to get to the let them in screen. Where is it?
You have to go to participants.
Okay. See, I'm doing that, and okay, got it.
That's extra dollars you have to pay for that service.
For which service?
The one that you just described. They want tax advantages, if they want planning, if
Correct.
they
Right. So you have to be at whatever level in order to have it. But at the same time, there are things that you can do for yourself, and we'll get into more detail on what you can do yourself, or get help, or get started, or things of that nature. So I'm a fractional CFO and controller. I have 6 clients right now that I work with part-time. What that does is a traditional CFO can run anywhere from $100,000 to $250,000 a year. Sometimes they're a little bit less depending on the size of your company. Controllers can run from $60,000 to $80,000 a year. I'm a fractional CFO. It doesn't nearly cost my clients that much money. I charge a monthly fee, and I'm able to look at their books, look at their information, make sure it's accurate, help them with any new plans or implementations, get more effective, efficient systems for them, check for big and small cash leaks, help them with controls. You know, sometimes you have people there that you don't even realize that you've had working for you for I don't know how long, and little things go missing here and there, and sometimes that can be a big issue. Helping you create your vision. You know, if you want to expand, what do you need to do? Where should we go? How should you do it? Do you want to make an acquisition? Doing some sort of work to help you decide whether or not that acquisition is actually going to be beneficial and good for you. Those are the kinds of things that I do. One of the things that I want to be certain that people understand is that 90% of entrepreneurs, especially people who are just starting out, are not doing something fundamentally important, which is to track your business and personal finances separately. You don't know your true profit. Why are you in this business? I know part of it may be to write off some, we're talking about writing off and saving money, but you also want to be making money at some point in time. And you won't know that if everything is all together with your personal and your business, as well as the fact that at come the end of the year, now you've got a shoebox full of receipts, and how do you even know, what goes to what? The most confusing thing that I end up running into is very small businesses that end up like this, and I have to start separating all of this information out. It's a little painful until everything's done, but it's certainly to your benefit. The day that you decide to open up a business, go get a separate checking account and run everything through that. Imperative.
And Victoria, is there a limit on how many years you can take a loss in your business?
No.
Okay, thank you.
There is no limit. All you have to do is prove that you are in business to make money. And the way you do that is you just working your business 2 hours a day, 5 days a week, It's up to you to prove that to the IRS if that should ever come up.
Keep
It's
good
not for them to say, hey, you know, you're not doing that. There's nothing written. It's a myth that you have to make a profit. Remember, Amazon has not made a profit in how many years? I don't know, 10 years, 15 years. They're in business. You know, there's many big businesses out there that haven't made a profit in years. So it's a myth.
Okay, got you. Thank you.
Mhm. So business records. Again, I put 24,000. You can do less, more. The minute that you can afford to do QuickBooks Online, please. So important. And here's why it's important, because spreadsheets don't cut it. You have to have what they call a balance sheet and an income statement. A spreadsheet's an income statement. It's a cash flow. It's showing you money in, showing you money out. But if you have any assets, if you have any liabilities, they're basically getting hidden. You don't see those. As you start growing, you definitely, banks are going to want to see full financial statements. I would suggest if you're first starting out with QuickBooks, once you learn how to use it, you can use it. It's not that hard to use. I like using it. There's other options out there. I know there's Quicken, don't care for it, but some people use it. There's another product out there called Hurdler. There's some other ones, Zero, I think it is. Some other ones out there. Here's what I would suggest to you. Spend a little bit of money when you're starting your business to hire an accountant to set up your books. And here's why. You may not, because you're not an accountant, and accounting is a debit and credit system with certain things that go on balance sheets and certain things that go on your income statement, income, expenses. Having your books set up for you the first time correctly will help you so much, because it'll all be set up and you don't have to worry about, okay, now I've got the payment in there. Where do I code this to? Where does this go to? Also imperative, and it's one of the reasons that I've started the business that one of the other businesses that I'm working on, which is the Women's Business Strategy Network, is to learn how to read your financial statements. What does it all mean? And then also to create a business budget. These things help. It's the vision. It's where you want to go. It's making sure you're on track. If things aren't quite right, you know where you need to go to fix, you know, an issue, or to recast and see what else needs to be done. Okay. And somebody asked me about books and things of that nature. We'll get to, I have those things in there. So we are going to get to those. Next. Okay. So now I'm going to go into deductions. And these are just a couple of them. There's a lot of things out there that you can do. Matter of fact, one of the books, somebody asked me about that. There is actually a book out there that I'm going to recommend as we get further down called 475 tax deductions you can take. And then most current one for 2019, 2020. But automobile deductions are insanely profitable, can save you so much money. Oh, that got in the wrong. Okay, whatever. So this is the book I was talking about, Lower Your Taxes Big Time, 2019, 2020. I'll post this so that you can see it. Small Business Wealth Building and Tax Reduction Secrets from an IRS insider, guy named Sandy Botkin. There are a lot of other books out there as well, but this is nice because it kind of, it does go through a lot of the detail. I also will be posting a tax deduction worksheet in the Facebook group and a home office deductions worksheet for you. So you can do your home office deductions. Okay, so there's two different types of deductions you can do. You can do the IRS give me standard mileage rate, which varies every year. I think it's 54 cents or something like that per mile right now. Or actual expenses. I like doing actual expenses personally. I think that you get a bigger deduction for it. What you're going to do is, this is an example. If you had $12,000 in actual deductions, 80% of your car is being used for business purposes, $9,600 worth of deductions. That means for gas, oils, repairs, supplies, car washes, etc. By the way, parking and tolls are 100% deductible, even though you would think they're car, they're more of a travel, but those are 100% deductible. Okay. Yes, you have to track your mileage. Now, there's different ways you can do that. There's a whole bunch of different apps you can do this with. You can track all your mileage through the year. You can track it perfectly for 90 days and multiply it by 4. It can't be seasonal. You should keep some sort of detail, whether it's Outlook or something to detail where you're going to. Now, driving from home to work doesn't count. That is not a business deduction. However, if you drive from home to the bank, go meet somebody for your business for lunch, and then go to your office, the mileage until you go from the lunch to your office, all that mileage in between is deductible. If you go from your office to the office supply store, that's deductible. If you go from your office to the post office, that's deductible. So there is some limits. QuickBooks actually has a really cool, their online app, their app actually has mileage tracking in it. And there's other ones where you have Google, attached to it, so it can help you track mileage. Again, a lot of this I'm just kind of cursing over it. There's so much detail that I'm not, going through a huge. 54.5% is what the mileage is. So you can see that was less. It's almost never a good idea under the new tax law. You can't claim gas, oil, and repairs. There's no depreciation. There's a lot of things that you can't claim. Oh, by the way, on your when you're doing your vehicle, part of what was there also is depreciation on your vehicle can be deducted. Oh, here's a little thing. Here's another one. Both require the mileage logs, but there, like I said, there's all kinds of little apps that you can use that will help you record. The main thing is record your purpose, consulting for here, going here for this, doing this, whatever it is, little apps that you can do that with, or a notebook or whatever it is. When your tax return is signed, you have to have records to prove mileage. I know when I do other people's tax returns, it is one of the areas. There's several little spots in the tax return that says, do they have proof of this mileage? I have to check a little box that says, yep, they have proof. So just letting you know. So another thing with cars, with vehicles, right now, buying a vehicle is a great option, and there's even better options depending on the size of the vehicle you're buying. There's something called Section 179. I think it's good up to $1 million worth of assets that you buy, where you can write off that expense 100%, or whatever your business usage is, 90%, whatever it is. Buying versus leasing, it's better to buy than to lease. And again, there's a whole lot of detail that in that book will give you so much more explaining the nitty gritty and the details, but this is just an example where this is a $50,000 truck, use it 90%, they could deduct $45,000 in the first year. We're going to go into travel expenses a little bit. There's several different ones. There's, as I was explaining before, the transportation expenses going here to there to go pick up something or do something on behalf of the business. On the road expenses where you're traveling. So that's you're flying somewhere, you're driving to a conference, you're driving to to an event that is on behalf of your business. Basically, you're going to UPW Live, your airfare there, all of the expenses that are necessary to get there. The expenses, all expenses are allowed except meals. Meals actually has changed a little bit. It's normally 50% for travel, but then there's some instances where meals actually can be 100% deductible. And in instances, you've got 4 employees that work for you. everybody has to stay in for a special project and work. You buy them lunch. Lunch is 100% deductible. Okay, so that's just an example. So there's several different rules for that.
Oh, Victoria.
Yes.
In New York, it became difficult because it said it had to be 50 miles away that you were allowed to deduct your meal. But all the work I did, we didn't have a refrigerator. I was like independent contractor. There was no even place to put your food. But it had to be 50 miles away. And it was just so awful because we were all over the city, but never 50 miles away. So anyway.
Is that a state rule? Because that's not an IRS rule.
That's what my accountant told me. It had to be 50 miles away.
I think she's kind of confused with the moving. If you move from your
Correct.
place to a different place, it has to be more than 50 miles.
That's true.
But my jobs were all out of my house. They were at this grocery store and that street fair and this trade show, but it wasn't like we're in an office, so we don't have a refrigerator. We would have, I mean, you could bring your food, but the idea is you had to many times eat where you were.
But here's the thing. Did you provide the meal or did your employer provide the meal?
Oh, no. These are all like you have to provide your own meal.
Okay, so in that
pays.
case, it's just a regular living expense. It would not be deductible. The only way it would be deductible is if to your employer, if they provided the meal. For you just to go and eat, the only way that a meal is deductible for you is that if you're going to meet with somebody for a business purpose. I mean, I guess you could say that you're meeting with your client for a business purpose. You would have 50%.
You're working for somebody, but nobody's going to pay for your meal, but you're not at home and you don't have anywhere to keep it. It's like, but he said it didn't matter. It had to be 50 miles away.
Yeah, I would have to defer. That's incorrect information. And this is what happens. So I'm going to say that a lot of times part of it is how it's being explained. Again, you're dealing with somebody who is dealing with a lot of tax returns, a lot of information. Sometimes they're not listening. It's not just how you explain it, but maybe they're not listening to the whole story. I'm going to defer to say that does not sound correct to me. I agree that it is more, that 50-mile issue is more of a moving expense, which those are all gone now. There aren't those itemized deductions anymore. Now you've got that nice big $12,400 deduction. So I'm going to go back to the travel stuff.
So I have to ask for another guys here. A strip club is tax deductible, right?
Absolutely not. No more entertainment, no football games, no baseball games, no strip clubs, no entertainment expenses are no longer zero, nada, not deductible. So sorry. Reasonable meals, yes, but nope, entertainment, no. So for travel, so here's another kind of cool thing. So how many of us like to go traveling to a conference? But we get to the conference and you know how sometimes those conferences you aren't there all day. So you know what really counts. So here's what counts. You have to be there. A bona fide business day is 4 hours and 1 minute. So if you can sit in your chair for a conference for 4 hours and 1 minute, and you spend the rest of the day golfing or going to Disney World, you've got a bona fide travel event, travel expense that you can write off on your business. On the road, anything that sustains life, your food, your lodging, your laundry, the cost of getting to and from, those are all bona fide business expenses when it comes to travel. So here's an example that, if you wanted to sandwich a weekend in, you have a travel day, which is Thursday. You work for 4 hours and 1 minute on Friday, and you work for 4 minutes and 1 minute on Monday. you get Saturday and Sunday and you're traveling on Tuesday, you get to deduct all of the expenses for that. So again, you go to out to where's Tony Robbins out there, Fiji? You can deduct your Fiji trip. As long as you're there for 4 hours and 1 minute at a conference.
So Victoria, if I was traveling a lot, like to Paris and to Europe and to California, and I would go out there as an actress for pilot season, and I have to rent a car, and I'm going out on auditions, and I'm there for, you know, a couple of months. Is that all considered travel expenses? If I live in New York, but I fly out to LA to go look for work, you know, going on auditions and.
So you're staying in a hotel room all that time?
No, I mean, I would be staying with friends, but I'd rent a car, and that would be like $1,000, you know, like I'd rent a car
Yeah,
and the
you could-
gas.
You could write off your, you could write off,
Yeah.
you could write off the percentage of your car rental that's being used for your business purposes. I would say that if you have personal purposes, you know, back to mileage and tracking and all of that, I would definitely do it more as what am I actually participating with for the business? You
Okay,
know,
so
I would do it more as a percentage as opposed to, hey, these are my expenses for 2 months. You know, here's everything there. You really should detail more, and the main thing is documentation. What are you doing that's on behalf of your business? Everything that's on behalf of your business, you can take. So if you rent that car for $1,000 and you use it 80% of the time that you're there to drive around to find jobs or to go from one job to another to look, you know, one place to another to look for a job, that is, but the rest of it that you're using personally, no. So it you know, it gets to where you have to use some judgment there and reasonableness, you know. So that's the best I could say to you, and just document it.
Okay. And then one other question also with this new deduction, the 12.5. I did my own taxes this year,
Mhm.
and I, you know, figured out like my expenses were more than the 12,500. I have a small, you know, I have a LLC as well. And then my own personal stuff as an actor, I have a film company, an
Mhm.
LLC for that. And it didn't, like the 12.5 didn't serve me, you know, those expenses. And it was harder because like I was used to like deducting, you know, and also as a performer, you're used to deducting expenses, but you couldn't do that this year. You just had to take that one deduction for that, but I could take it for my business. I was able to take it for the LLC company. So yeah.
You aren't writing your expenses under your LLC. You're doing that separately, like on a Schedule C.
Yeah. So I did it because my business, you know, didn't make a lot of money last year. You know, so it made some money. It was, you know, it's all through people donating money to the film. You know, I'm trying to raise money for the film, but the expenses were higher than the amount of money that came in for the film. But then there was money from other places. So I took a Schedule C. I did a Schedule C for on top of it to be able to deduct all the expenses that I had.
Right. Did you have any withholding taken from any paychecks at all?
Very little.
Okay, so you should have gotten that money back.
It was either 1099s or it was all 1099s or very few W-2s. And
okay,
yeah.
So if whatever money was withheld on W-2s, if there was any, you would have gotten that money back. And then you just file for a loss. That's fine.
Yeah.
You still have to pay your Social Security, you know, your FICA taxes, but other than that, you could have gotten money back if any W-2 was there.
I got a little money back.
Yeah. Okay. So the next little section, this can get kind of detailed as well. You can hire your kids, pay them reasonable wages. You have to keep timesheets. First $12,000 is income tax free. There's no Social Security or federal unemployment if they're under 18. You know, they, again, you know, there's a lot here as far as how to set this up, what to do, how to do it. There are some drawbacks. If you are applying for federal, if you're ever going to choose or have to apply for student aid as your children get older, there may be some issues with that because they are showing some income. So it depends on how much you get to pay them. But what has been recommended basically is instead of you paying their expenses, you pay them and they pay their own expenses. It's a really great way to teach them how to manage their own money very early. There are a lot of mechanisms to help get this set up. So I don't want to go into a lot of detail again with this because it can be, it can definitely take some time, and I do want to try to get through. So again, I encourage you to look at the book that I recommended, and you can certainly ask me questions after we get through this. But I just want to let you know that you can do this as a legitimate employee. The main thing is that you just have to make sure that you, you know, that you pay them a reasonable amount. In other words, if you're going to pay somebody $10 an hour to stuff envelopes or answer emails or post on Facebook or, you know, do whatever other little jobs that they can do for you, you can pay your children for that too. So health insurance premiums are fully deductible if you're self-employed. However, there's a few small rules. If you are the more than 5% shareholder, you have to declare that income. There's some other ways around that, but you can actually deduct your health insurance premiums. I'm in the process of setting up an HRA for a client, in that there's some mechanisms in there where you can do not only your health insurance, but any medical bills and other expenses that come up during the year can be done. Deducting your premiums cannot create a loss for your company, however, but it does apply to long-term care. So you can deduct those. So another thing that is deductible is charity, social giving. So I know that we've talked about that briefly here. It's 100% tax deductible as a business expense. There's a lot more of a limitation of what you can charitably deduct. When you're doing it as a business, it's 1-to-1 as far as deducting expenses. I just came across in this Charity Navigator a giving basket where you can actually give to multiple charities at once. You can set up recurring donations, get one tax receipt, etc. The biggest thing with charities that I've come across with owners is please make sure it is a legitimate charity. It must be a 501c3. I have had people who said, oh, you know, I have my friend down the way that is taking care of some children riding horses and I'm donating food to them, you know, that I buy at the feed store. Well, I'm sorry. It's lovely that you wanted to donate to them. But if they're not a charitable organization, I'm sorry, I can't write that off on your, you know, on your taxes. It's not legitimate. So please don't fall, you know, if you fall into that where you're helping someone out, it has to be a charitable contribution. Preferably get some sort of documentation. So just letting you know that that's certainly very important to keep in mind.
Do you set up 501Cs, Victoria?
I do not set them up. They're very complex. I have, wow, it's a lot of work. But I can certainly recommend, I can find somebody to recommend.
Yeah, I have a client that is opening a church and they got to go through that process, and it is complex.
It is, and sometimes you have to have 2 or 3 years worth of documentation. There's different levels of, yeah, it's is complex. So not something that I do. Work-related education expenses. This is where we get to write Tony off. Or any other of the books you're buying, any educational materials that you're buying to improve your skills, maintain your skills. Any law that comes up that requires you to keep your present salary, status, or job, tuition, books, supplies, travel costs, transportation. You know, I mean, I've even read that if you had somebody, you're doing some sort of paper or whatever, you have somebody type it up for you, you know, that type of thing can be written off. So there's a lot there. If you're looking to start a business, these would be the areas that I would say would be the most economical to start in. Network marketing, affiliate marketing, direct sales. These are perfect home-based business because there's very little cost to get involved. Again, 45 minutes, 3 days a week, legitimizes your business. You have to have a motive that you are in this to be in business to, you know, to create money, to create income. That's the biggest thing that you have to have and to do in order for this to work. There are other things out there, obviously traditional businesses. There are franchises. Franchises, in my opinion, most of the people I know that have them are basically buying a $15 an hour job. So just be forewarned that you do a lot of groundwork and legwork to make sure if you ever decide to buy a franchise that this is really something that you want to work in for the rest of your life. I've seen a lot of people really suffer with those. So just be aware. Now, there are probably some that are incredibly profitable and that work, but generally, I would have to say that these are the easier ways to get involved really quick, very, very fast, and be able to write off some of your everyday expenses as tax deductions. So statistically, 46% of Americans don't have an extra $400 to their name. I know we've discussed that before. And 69% don't even have an extra $1,000 to their name. Well, why is that? It's back to the very beginning of the slides that I was showing you before, which is a lot of money's going to taxes. Some of it we can control, some of it we can't. You know, sales tax, not so much. Although I will have to say that some things that you purchase, if you purchase it for your business, you're purchasing a computer for your business, you pay sales tax on that computer, that gets written off in your business. You're not only not paying for the expense of the computer, but you're not paying that sales tax. So that's a good example of where you're not paying that. Same thing when you purchase a vehicle. Same thing when, there's a lot of things out there that you buy that if you redirect those into your business, there are some tax benefits of that as well, not necessarily income tax, but maybe sales tax and some other benefits. So here's the couple of websites that, again, I'll post these, but just make sure that you understand and know that these are available. So the Paycheck Checkup is a link you can go to in irs.gov where you can go in and you can estimate your withholding or estimate your tax liability for your income tax. Remember, your FICA, which is Social Security and Medicare, is set. There's not a thing that you can do with that. That's 7.65% of your paycheck. But your federal withholding, you can go in and there's a nice little widget in there where you can put in all the parameters, have your last paycheck that you just got issued, go pull up your W-2 stub, put all your information in there, make sure you're withholding enough, or that if you're over withholding, you can request to the payroll department for this last paycheck of the year, if you're withholding too much money, for them not to withhold any money from the next paycheck. You have a nice little Christmas bump that'll go directly to you. I just find that,
Victoria,
yeah.
excuse me, can you mute everybody because there's some background noise? Somebody, I think, forgot.
Let's see here.
Just mute all of us.
Oh, okay. Everybody's muted except you, so you're going on mute now. Perfect. Okay, sales tax calculator. So the government will, the IRS will let you, when you're doing your tax return, write off a calculated amount of sales tax. So you're not keeping track of every single sales tax that you spend. There's actually a tax deduction calculator, which a lot of people don't know is there, that you can put, use that widget to see how much sales tax you can put on your tax return to write off. And then in this day and age, the last thing I want to make sure everyone knows about is that identity theft is a huge problem out there. If you have been the victim of identity theft, specifically IRS, you know, somebody took your number and claimed your tax return and got your refund back, or, you know, filed under your name, you can get what is called, now there has to be fraud, you have to prove fraud, but you can get what they call an IP PIN, which is identity theft PIN. I don't think that opens up until mid-January for 2021. But if you ever have that, a lot of people don't know this is available. If you ever have that problem, you can go and get an IP PIN. Okay. And yay, I did it in my time frame. Well, almost. I was actually thinking it was going to last an hour. So thank you. That's it.
Victoria, can I ask you a question about inheritance? If someone gives you money,
Yes.
is that taxable?
Yes.
Inheritances.
Yes, there's something called inheritance tax.
Okay. Oh, and what about a gift?
So gifts, there is gift tax, but there's some gift that can, some level of gifts that can be given to you tax-free. I want to say it was, again, I'm not a tax expert, I'm letting you know, it was like $10,000 per person. It may have gone up now. I don't remember the tax law right off the top of my head.